Hello everyone, all civil services students. I hope your preparation is going on very well. Devi sir is posting all his pending syllabus videos. Please have patience. If in case video is very lengthy, if you think that the classes are not very effective, it's because of the mode that we are following. My sincere request, make sure that you take a pause while you are listening to the videos. Force yourself. Put your presence very effectively. You will be able to understand the videos. And there's no option at all. If there is any option, yes, we can, but we are trying our level best with the help of existing resources that you will be uh, having some classes, so that at least 2 hours a day, if you could occupy yourself, yes, it is done. Once the syllabus is finished, maybe from next month onwards, the whole June, maybe the dates will be announced, but from 20th May or 25th May onwards, we have to start writing mock exams, especially the students who are writing prelims in the month of June. Let them announce, then based on that, we'll take a call. At least 10 mock exams if you are able to write, or 10 to 20 mock exams if you are able to write. I think you can have some change. Let's get to the today's lesson. So earlier in my class, I was covering about money market instruments. And if you have not yet watched the video, please go back and watch the video. And those of you who have not yet subscribed, please do subscribe, so that any notification that we have, and also press the bell icon, so that any notification, any new videos that we upload, you will be notified, so you will not miss anything. That is the only option. And try to share with your friends if in case they're not in the group, or they're in need of these lectures. What is capital market? I said Indian financial system has got two important things: money market and capital market. Money market deals with short term lending and borrowing, whereas capital market deals with long term lending and borrowing. Under capital market, as I told you, we have got two very important markets, that is securities market, non securities market. Yes, securities and non securities market. I have already given a list of security market instruments before, and non securities markets, for example, mutual funds, that also I gave you in the earlier lecture. Please go through it. So capital market is basically a market which deals with long-term claims. It has got two markets: securities market and non-securities market. And the second thing, securities market, we have two very important things, that is primary market, secondary market. Security market, you have got primary market and secondary market. Clear? And in primary market means, I told you, company will issue a prospectus, and investor will invest money directly into the company by submitting an application form based on the prospectus. So when you purchase shares directly from the company for the first time, you are in primary market. If in case you go to stock exchange and purchase shares from stock exchange, you are in secondary market. Capital market has two types: securities market, non-securities market. Secondary market is nothing but, securities market has two types: primary market, secondary market. Primary market is a situation where investor will invest directly into the company, whereas secondary market, you will go to stock exchange and invest in stock exchange. You buy the shares in stock exchange. That is the introduction, we have already studied. Our job is now, what are the instruments? You have to look at the material, make sure, read this material thoroughly. This is designed in such a way that your prelims and mains exam can be easily managed with the help of these notes. Okay, unless and until you practice questions on this, you won't be able to understand what exactly and how exactly the concept is going to be tested in the exam. So first focus on the concepts and revise if in case you did not understand, and have a fundamental knowledge. Don't try to be like a PhD doctorate. You don't need to be. You just have a fundamental knowledge of every concept, and thereby start practicing questions. Once you start practicing questions, you will be able to understand exactly what is what. First instrument in capital market, debt market. When you hear, as a common man, when you hear the word debt market, company would like to raise money in the form of bonds and debentures. Company would like to raise money in the form of bonds, and these are very two popular instruments. So under debt market, we have got wholesale debt market of National Stock Exchange trading platform is given them, and bonds and debentures will be sold on National Stock Exchange trading platform. We have got government securities, treasury bills, we have got state development loans, we have got bonds issued by public sector enterprises. We have got floating rate bonds, in the sense bonds whose interest rate vary. We have got zero coupon bonds. Yes, we have got, I mean, zero coupon bonds. We have in bonds, different types. In the next class, I'll discuss, because now each type will take a lot of time. Right now, in the debt market, what is there, you please understand. Okay, all types of bonds in the separate lecture I'll give you. Okay, that will take minimum 30 to 40 minutes. We have floating rate, floating in the sense change of interest. Zero coupon bonds, we have index bonds, we have commercial papers. You have commercial papers. Now, don't get confused. Commercial papers are already there in money market. Certificate deposits are already there in money market. Corporate debentures means debentures issued by companies. Okay, SLR bonds, statutory liquidatory non-SLR bonds, etc., issued by financial institutions, and bonds issued by foreign institutions, and units of mutual funds. All these, some of them are already there in money market instruments. So debt market instruments are dealt both in capital market and money market. Debt market instruments are dealt both in capital market and money market. Yes, clear? Then move on to the next point. Next point is debt instrument. Debt instrument represent where, I mean, when one party lends money, that lender will issue a certificate as an acknowledgement of debt. Suppose if I'm lending money, you need to acknowledge that we need to create a certificate. In that certificate, it is a proof that you lent money to me. Clear? So, best example, bonds, debentures are certificates which are actually created when you lend money. That means when investor is lending money, I mean, lender is lending money. That means if I buy debenture, I am lending money. If I buy bond, I am lending money. Company is borrowing money. So company should create a certificate called debenture certificate or a bond certificate. These two are an acknowledgement of debt. So there are some differences between bonds and debentures. We'll study that in the next paragraph. Okay. Then we have something called bonds and debentures as debt instruments. See, bonds, debentures, both are loans, first of all. Yeah. See the first point. Bond is a loan given by the buyer. That means when I buy bond, I gave a loan to company. Clear? Companies, financial institutions, even government can issue. So who can issue bonds? Bond is a loan given by, if I purchase bond, I'm actually giving a loan to the person who's actually selling it. So let's say bond is sold by a company or a government or a financial institution. I take the bond and I give money. So I'm lending money, they're borrowing money. It's an evidence, right? That means bond carry a fixed rate of interest. Scheduled rate of interest in the bond carry a fixed rate of interest. And there are different types of bonds. Again, separate class I'll take when it comes to, right? Generally what happens is when the bonds are issued, bonds will be issued like this. Suppose face value of the bond is 10,000 rupees. They would issue for, let's say, they would say you give 10,000 rupees, the bond value will be later on 10,100. So at the time of receiving it, you will get 10,100 or 10,500, let's say. Whatever 500 that they are giving you extra will be called as an interest rate. That means bonds, you will get money at the maturity. You will not get yearly basis or monthly basis. Otherwise, sometimes what happens, a bond is issued like this. Bond value is 10,000 rupees, but they will ask you to invest only 9,000 rupees. 10,000 rupees face value bond will be asked to, I mean, you will be investing only 9,000 rupees. That means what? You pay 9,000, but at the time of maturity, you will be getting 10,000. So 1,000 rupees is basically the interest that is decided. When the bonds are issued, generally bonds will be issued for 1 year, 2 year, 3 years, 4 years, like this. So suppose I sold a bond of 10,000 for 9,000. Then 1 year, after 1 year, we'll take it. Suppose if 10,000 rupees is given after 1 year, but you invested only 9,000. So the fixed rate of interest, that is 1,000 rupees, you will be getting. Yes, that is the point. Now the next paragraph, if you could see, so bonds can be broadly classified as tax saving bonds. That means there are certain bonds which are issued by government, which are issued by companies and financial institutions. They would clearly tell you if you invest in these bonds, because those funds might be utilized for different sectors, infrastructure, etc., etc. So therefore government would tell you, if you invest in this bond, the income that is earned, I suppose 10,000 bond, I bought it for 9,000, so I'm going to get 10,000. 10,000, that is 1,000 is an income for me. So on that there won't be any tax. So there are some tax saving bonds, non-tax saving bonds, etc., etc. So what is the basic difference between bonds and debentures? I repeat, when you think about debentures, debentures are normally issued by companies, and bonds are normally issued by companies as well as government institutions, but the bond is mostly related to government securities. Slowly these bullet points you just go through. Debentures are bonds it's like debentures are bonds which have no collateral. In the sense, when I issue debentures are bonds which have no collateral. In the sense, uh, when I issue debentures, there is every possibility there won't be any collateral security. Suppose you gave 10,000 rupees to company in the form of debenture. Then what if something happens to company? Where is the security? That's why debentures will be of two types generally: secured debentures, unsecured debentures. There is a possibility debentures can be unsecured. In the sense, I invested money in the company, I bought a debenture. What if company is bankrupt? Then how do I get money? Generally what happens, company has to sell the assets and give. But if unsecured debentures, there is no security attached. But debentures can be secured and unsecured. Second point, if you could see, bonds are more secure than debentures, but the rate of interest, that means debentures will carry more rate of interest. Bonds will carry, both of them will carry fixed rate of interest. Debentures will carry more rate of interest, whereas bonds will carry less rate of interest, but bonds are more secured compared to debentures. Bonds by default are secured, but debentures can be unsecured also. That is the point. Clear? Third point, if you could see, debentures can be secured or unsecured loans, but carry. Debentures are secured or unsecured loans, but carry higher rate of interest. Understood now? That means, suppose if I issued secured debenture, which means if anything happens to company assets are attached. When the debentures are issued as a secured, a property of the company will be attached. If in case anything happens to company, that property of the company which has been attached will be sold and debenture holders will be paid. But you need to study the offer document carefully whether those debentures are secured debentures or unsecured debentures. Bonds are always secured. Clear? One point very clearly, both carry fixed rate of interest. Bonds interest rate generally will be low. Bonds interest rate will be paid on maturity, whereas debentures interest rate will be paid yearly basis. Debentures offer generally higher rate of interest because debentures can be unsecured and can be secured. So investors are advised to go for secured debentures. Clear? In capital market lesson, in the other lessons, we will explain in detail about how the interest rates and everything works, right? Third one, in bankruptcy, that means if a company or a financial institution or a government has gone for bankruptcy, bond holders are paid first. So if the company has gone, both of them will be paid, no doubt. Suppose there is an asset, there is a building of the company is bankrupt. Then building is sold. First preference will be given to bond holders. If there is a money left over, definitely debenture holders will be getting. So priority wise also, who are actually having a priority? Bond holders. Debenture holders get periodical interest, in the sense yearly interest they will get. Whereas bond holders, if I had issued a bond for 2 years, you will have to wait for 2 years. I said, company says very clearly, boss, here is the bond of 10,000, you give 8,000 and take 10,000. When that 10,000, when will they give you? After the maturity. That maturity could be maybe after 1 year or 2 years, depending on for how many years that bond is issued. Yes. Next one, if you say bond holders receive accrued payment. So that is the difference. Debenture holders year wise they receive a interest rate, whereas bond holders will, on completion of the term, if the bond is issued for 3 years, on the third year they will be getting principal and interest rate. Clear? So debenture holders will keep getting every year, fixed whatever it is there. Then next point, if you in the Indian securities market, the term bond is used for debt instrument issued by central India. You understood? I told the moment you hear in capital market bond, please do understand in Indian context, bonds are generally issued by central and state governments. Generally issued by central and state governments. Generally, this when central government and state government goes for issuing of bonds, this responsibility of selling bonds in the open market operations will be taken up by Reserve Bank of India. Public sector, or the term debenture is used normally for private corporate sector. In Indian context, when you hear the word debenture, when company borrows money, company will issue a certificate. It is called an acknowledgement of debt, that is debenture. When government goes for issuing of debentures, etc., this will be bonds. So the basic differences, once again you understand. In general, bonds are always secured. If anything happens to company or a government which has issued, nothing happens to bondholder, he will get the money. But when it comes to debentures, there are two chances. They can be secured debentures or unsecured debentures. If they are secured debentures, then fine. If anything happens to company, assets will be sold and money will be paid to first bond holders, then debenture holders. That is clear. But when it comes to debentures, you need to see very clearly whether they are secured or unsecured. Bond holders will be paid at lump sum once the maturity is over, whereas debenture holders will be getting whatever interest that is offered for each year. Every year they will be getting interest rate. When it comes to winding up of company, if a company is wound up or an institution is wound up, first preference will be given to bond holders, the second preference will be given to debenture holders. That is the point. In general, in Indian context, when you talk about bonds, we always refer to central and state governments. Bonds of central government and state government, when they want to, that means when central government, state government, when they want to borrow money, they will issue bonds, and this is the responsibility of Reserve Bank of India. Who will sell bonds of state governments and central government? That is Reserve Bank of India. Clear? Then when it comes to debenture, we always understand it is a loan borrowed by the company as a proof of certificate. This who will issue? Company will issue a debenture. Clear? Yes. That is one instrument. Clear? Move on to the next one, derivatives. This, in my earlier classes, I have covered. Derivative is an agreement. Seller A, I once again I'll just briefly explain. There is a person A and there is a person B. B wants to sell shares. Sorry, A wants to sell shares and B wants to purchase shares. A thinks that A wants to sell shares. A thinks that price will go down. B thinks that price will go up. The buyer who wanted to buy shares is afraid that the price will go up, so it will be a loss for him. Say for example, current price is 100 rupees. B is thinking it will go up to 150 rupees. Yeah, and A is thinking it will go up to, let's say, 50 rupees. So A will lose if price goes down, B will lose if price goes up. So there is a chance that these two people can have an agreement right now, right? These two people can have an agreement right now to purchase the shares at a future date at a price fixed today. So both of them can arrive at a price called, let's say, guys, let's go for 130 rupees. 130 rupees. So because this fellow is expecting price would go up to 150 rupees. If in case they have agreed to take the shares at 130 rupees, this fellow is getting profit, this fellow will save 20 rupees, no? But only thing is, so there is every possibility these securities value keep fluctuating. When there is a fluctuation, both the people, there is every possibility. So it all depends on predictions and speculations, right? Understood? So derivative is an agreement. See, read this. It's a product it's product in the sense it's an agreement copy, just like a share, whose value is derived from the value of one of basic variables called basis, underlying asset. Underlying asset means, suppose B wanted to purchase shares, then underlying asset is share. Regarding share, they had an agreement today to take up tomorrow, but price is decided today and they will be taking after 10 or 15 days. Index, underlying asset or index, reference rate, etc. All rates, everything they will decide in a contract. That contractual agreement copy is called derivative. What if later, suppose he had an agreement to purchase, understand slowly, he had an agreement to purchase shares at 130. Underlying asset is 130. What if he doesn't want to buy? He thought money, he will get money and money is not available now. Then he can sell this to somebody who would like to buy the shares because market may 150 hai. If market price is 150 later on and B doesn't have money to purchase, B can sell this agreement at 130 to somebody else. Yes. So that fellow will go and purchase shares from this fellow because in the market rate 150 is there. Understood? The underlying asset can be, like this. So it's like a future contract. It's like an agreement today you have to take certain quantity of shares at a future date, at certain rate, at certain date. And that agreement copy, if in case you are interested, you use it. Otherwise, you can sell it to anybody, just like another asset. So that agreement can be related to equity, forex, foreign exchange, or commodities, etc. That's why we've got commodity derivatives, forex derivatives, equity derivatives. In general, derivatives means equity shares. Simple language you apply. I'm a buyer. I have a fear that price will go up. So I don't want to take chance to pay more price next week. So today price is 100 rupees. I will have an agreement with this fellow, guys. Let's have an agreement I will buy at 130. Because I am scared that price will go up to 150 and this fellow is scared that price will go down. There are always two bulls and bears. There are two people, right? One is optimist, one is pessimist. So for such people, obviously this will help, right? Think in a general ways, then you will understand this. Example of derivative, like wheat farmers may wish to sell their harvest at a future date to eliminate the risk of change in price. Right now price is so and so. The farmer might think price will go down. So it's better to have an agreement with somebody who will take wheat at so and so fixed rate, right? Better than the current rate. Understood? Pricing of derivatives. Pricing of derivatives. So pricing of derivative is driven by the spot price of wheat, which is the underlying. So regarding wheat, I came to an agreement. So wheat is called underlying asset in my example. So price of that agreement is dependent on that time what is there in the market. Yes. Who governs this? So securities contract regulation law. I mean, regarding any rules and regulations are given by Securities Contracts and Regulation Act rules will apply in India regarding derivatives. Yes. Now definitions. Definition of derivatives I have given a security derived from a debt instrument, maybe bond or a debenture, share or a loan, etc. So regarding these instruments, you can have a contract. What is this contract? So suppose you have an agreement today to take them tomorrow. Suppose you have an agreement today to take shares. Underlying asset is share. You have an agreement to purchase debentures at a future date. Then underlying asset is debenture. Understood now? Whatever security that you have decided to buy at a future date at an agreed price today, that is called this one. So why this is like hedging, right? You are actually postponing. You are minimizing the risk. There is a risk of increasing price. There is a risk of decreasing price. One of them will be at loss. So better to have an agreement today at a common price. In this way, dealers and brokers will play a key role based on the trending of prices. But of course, sometimes topsy-turvy, anything can go wrong, anything can happen, okay, in the market. So derivative products initially emerged as hedging securities. When I say hedging, what I said, these are all postponing. The hedging means postpone. Why am I having an agreement today? A simple question. Why am I having an agreement today? Wherein I say these many shares I will buy at future date and at this price only, because I'm scared that prices will go up. So I'm postponing the risk, right? That is what. And financial derivatives came into spotlight in 1970s, the general point. However, since their emergence, these products have become very popular in 1990s. Okay, so these agreements can be sold. The following three broad categories of participants, like hedgers are there, speculators are there, arbitrageurs are there. About these concepts also I'll explain separately in the next class. So make sure until then you understand who are the participant. This is very important point. Who are the participant? There are people who are trying to help investors and companies to postpone the risk. Sellers and buyers will have a lot of risk when there is a fluctuation of prices. So there are hedgers, speculators, arbitrageurs. Arbitrageurs are third parties who will take up these contracts, etc., etc. Derivative contracts have several variants. The most common variants are, this is very important again, this is very important from the prelims point of view, please. Derivative is an agreement. Today you have to take securities which are underlying at a future date at a determined price today. You've got forward contracts, you have got futures, you have got options, you have got swaps. In my previous class, I think, but briefly I'll explain once again. I covered, but once again. Key point to understand. So all are future contracts only, like option, forward, future, option, whatever it is, everything is related to derivative. Derivative classes, these are all. A forward contract is a contract between two entities where settlement, please do understand. Settlement will take place. Settlement in the sense handing over of securities, making a payment will happen not now at a future. But today they have an agreement. Settlement. Delivery of securities happens at future date, but agreed price today. Payment will happen at future date, but agreed price today. Settlement. Futures, you see, it's an agreement between two parties to buy or sell. One fellow has come to an agreement, I will buy. The other fellow will say, I will sell at a future date. So here agreement is done, everything is done, but the payment will, in forward contract, payment will happen later. Delivery of securities will happen later. But here this is an agreement where one person has agreed to buy, one person has agreed to sell at a future price. Got my point? So future contracts are special types of forward contracts in the sense former, that is forward contracts are standardized, whereas future contracts are not very standardized. In the sense forward contracts will happen in a very systematic way with a mediator, etc., whereas futures may not have standard contracts. So that means forward contracts are mostly protected, futures are at the risk of the people. So one related to settlement, one related to buying and selling at a future date, right? Options. Options are of two types, I said. I mean, derivatives can be having, I mean, future contracts can have two types. Okay. That is call option, put option. In my last class I covered. Call give a buyer, that means if you have bought a derivative, call give a buyer the right but not the obligation to buy. That means when I have a call option in the agreement, I have a right to buy, but I am under no obligation to buy the quantity of securities. Whereas put option give a buyer right to sell, but not under the obligation. So do one thing. Call option is I have an obligation, I have a right to buy, but I don't have any obligation to buy. Put option, I have a right to sell, but I don't have any obligation to sell. It's all about obligations. Okay, the contract where when you have an option, when you have a derivative contract with call option, what does it mean? You have a right to buy. Means when will you use that right? If you think that it's going to be profitable for you, you will use the right to buy. That means the other fellow cannot force you to buy at any cost. Suppose if there is any rate fluctuation, other fellow will say, no, you must buy. You will say, no, I will not buy. Because I have a right to buy. I don't have an obligation to buy, right? Whereas put option, you have a right to sell. That fellow, suppose if it is profitable for that fellow, he will ask you to sell. Then you will say, no, I have to decide whether to sell or not. I don't have any obligation to sell. Because of the rate fluctuations, there is every possibility people might decide. Everybody clear? Yes? Now warrant. So this is the warrants, leaps, baskets. Warrants, leaps, baskets are related to options only. See there, warrants. Longer dated options are called warrants. Generally, options have a life up to 1 year. That means once you have an option to buy or to sell, whether call option or put option, whatever, it is valid for how many years? 1 year. It is valid for how many years? 1 year. Please do understand. Whereas, if in case they are longer than 1 year, they will be called as warrants. Clear? LEAPS. The acronym for this is Long-Term Equity Anticipation Securities. So, options which are above 1 year are warrants, and options which are up to 3 years. So, you can use those options for how many years? 3 years. When I have a call option, what does it mean? I have a right to buy. I don't have an obligation to buy. When I have a put option, I have a right to sell. I don't have an option. So these options validity period, no. This is an agreement, right? Which will happen at a future date. So how many years it is? Normally options are valid up to 1 year. If in case they are more than 1 year, we will call them as warrants in this language. Simple language I am using so that you will understand this. Leaps are basically options which have a maturity up to 3 years. 1 year to 3 years, right? Baskets. See, in every derivative there is an agreement. In that agreement there are underlying securities. One security can be share, can be bond, can be debenture. Yes or no? What if I want to have a bunch of all like shares, bonds, debentures, all different types of securities together? I want to basket. In the basket you have various. So see there, baskets are options on portfolio of underlying securities. Underlying securities usually moving average. I mean average price they take. Like all types of securities, they will put it as a bulk in that. Based on the stock exchange index, they will decide the rate, average rate, maybe weekly average, fortnight average, or monthly average, 3 months average, 2 months average. Like this, they take and decide the price. So you're going to buy a basket of securities. Yes, swaps. You understand like this. Swaps. If your swap means exchanging. Okay. Say for example, there are two people, A and B. Simple funda. A wanted to borrow money at fixed rate and B wanted to borrow money at variable rate. A wanted to borrow money at fixed rate of interest, and B wanted to borrow money at variable rate, changing rate. Variable rate, normally we follow LIBOR, that is London Interbank Offer Rate. It keeps fluctuating, it keeps changing. Okay. So let's say he has a fixed rate loan at 7%. He has variable rate loan at let's say 10%. 10%, 7%. Variable today it is 10%, it might decrease now in future. What happens is, in between there will be a swap bank. This fellow has an option to borrow money at so and so interest rate, and this fellow has an option to borrow at so and so rate of interest. He can borrow money, and swap bank will take money from this fellow at so and so rate and will give it to this fellow, because this fellow is looking for less interest rate. This fellow is also looking for variable interest rate. He has a fixed rate option, he has a variable rate option. Both of them would like to exchange. So he doesn't want to go for variable. He has a variable option, he wanted to exchange it for fixed. He has a fixed option, he wanted to exchange it for variable option. So that's why we have got two things, you see: interest rate swaps, currency swaps. So see here, swaps are private agreements between two parties to exchange cash flows. Money that is to be borrowed, they will exchange cash. When this exchange of cash can happen only when the interest rates vary from one segment to another segment. They can be regarded as portfolios of forward contracts. Okay, the two commonly used swaps are interest. These entail swapping only interest related cash flows. The cash, I have an option to take a variable rate, you have an option to take fixed rate, you want to have a variable rate, I want to have a fixed rate, we both can exchange. So I'll take money at variable and give it to you at fixed rate. You will take money at fixed rate and give it to me at variable rate. So in between there will be a swap bank. There will be an intermediate. I will also share one flow chart of this in the next video. Otherwise, I'll just put it on WhatsApp group. How exactly swap happens, because I'm not able to explain. I don't have a pen to write here. Okay. So swaps can be, at this point of time, you understand, swaps can be interest related. When there's a variations of interest rate, when two people have a benefit of two interest rates, then what one fellow can exchange it for. But in between, you will have a bank. Okay, bank will help exchanging these rates. Swaptions are options to buy or sell a swap. That means whatever swap that you have, these are all swaptions. For swap ke liye we have again options. Is an option. You can have an agreement at a future date that you will be swapping, because you are sure you will get money at this particular rate, etc. This is heavy for you actually. I will show you the flow chart on this swap, please. I'm not able to write on the chart here. Okay, so these are all instruments when it comes to what? Capital markets. Please go through it. These basics are very important here. Just focus on basics mostly. Okay. Yes. Then we have commodity markets. Commodity markets, in the sense, just like we have an agreement today to take shares and to make payment at a future date, we also have derivatives for commodities. Commodities like gold we have, like agriculture products we have, iron ore we have, silver we have, like a lot of commodities we have. Similarly, regarding commodities, we can have an agreement. Those agreements wherein at a future date we will have delivery of goods and we will have making payments, etc. Such things we will call them as commodity derivatives or commodity markets. Then we have equity market, you know very well. Equity market in the sense a stock exchange which deals with selling of shares and buying of shares, that is stock exchange. We have non-security market, as I told you before. We have mutual funds, bank deposits. These are all non-security. That means you will not have any security. They are not used as a collaterals, etc. These are all non-security markets. Insurance, post office savings, provident fund. Like insurance company raise money promising you that if anything happens to you, we will give you this much money, etc., etc. Such kind of options will be called as non-security markets. Then what is a mutual fund? Mutual fund lesson I've already covered in the previous class. Please go through it. Mutual fund is basically what basically does. It mobilizes money, pools money, and gives it to asset management company. Asset management company will go and invest in stock exchange, and whatever money that is earned in securities or stock exchange will be given to unit holders in the form of returns. There are different schemes like balanced mutual fund, growth mutual fund, pension mutual fund, income mutual fund, education mutual fund, etc., etc. There are so many types. This earlier class I've already covered. You need to understand one very important in capital market, basically what we deal with. That is the fundamental question first. In capital market, what do we basically deal with, right? That is what you need to understand. One is, so if you could see one by one is debt instruments, we have bonds and debentures we have. Okay, we have got derivatives. Under derivatives we have got different contracts like forward contracts, future contracts, options, warrants, leaps, baskets, swaps. We have got swaptions, etc. Okay, swap becomes an option, that is swaption. Okay, under that we have you can exchange, you can have an option to buy or sell at a future point of time. Then you have derivatives related to commodities like gold related, etc. We have got equity market where in stock exchange we sell shares. Okay, we have got non-securities market, we have got mutual funds. These are all components of what? Capital markets. About mutual fund structure, operation, again separate classes I will be taking. About swaps also I'll give you a flow chart later. Until then you just understand these are all capital market instruments that we normally deal with. Have a nice day.